I'm Ralph Ibendahl. I run the energy transition business for Europe. I'm here with Ross Board, who's a director in the energy transition team, and Paul Betts, who's a managing director in our M&A team. We're here today to talk about the battery value chain and particularly what we're seeing amongst investors. Paul, maybe you can start us off with what you're seeing across the battery value chain from an investment proposition perspective.
So what's obvious is that this battery value chain requires a huge amount of capital to develop various verticals to ensure the success of the EV ecosystem. There are various different pockets which have different investment criteria which appeal to different types of investors. I think the most capital intense is battery manufacturing. Billions of dollars are required to be invested into the space to bring online the battery capacity required for the EV ecosystem. And the dilemma we're facing is that as it stands today, these companies are mainly startups and they would ordinarily appeal to VC type investors. But you can't go and raise billions of dollars of capital from VC investors who are writing checks of in the tens of millions. You need investors that are clubbing together to write tickets greater than 200, 300 million to ensure that these projects are fully funded. For that reason, you need to be appealing to sovereign wealth funds, pension funds, infrastructure funds. However, those investors are obviously savvy, sophisticated investors. They have strict investment criteria, and generally they're looking for infra-like type investments, which this space doesn't currently offer. So British Volt is the first example in that they were looking to raise $5.5 billion to bring 38 gigawatt hours of capacity online. But to do that, they need investors to come in and write significant ticket sizes. What we're seeing is that infrastructure investors are doing a lot of work to get up the curve to try and understand the space. But when it comes to actually pushing the button, they can't yet get comfortable with the risk-return profile. And so that's something that we're looking to address. We're seeing a lot of money being invested in EV infrastructure, as you guys in the infra side know. But the question is, how do you fund battery manufacturing? Because without batteries, those investments into EV infrastructure are not going to be worth much.
Paul, you've talked about the battery manufacturing side. What do you see even earlier when it comes to the mining side, the input side onto battery, in terms of who's playing there and how that ecosystem is evolving?
Up until now, we've never seen the likes of OEMs participating in the mining space, but obviously in order to secure future volumes of nickel, cobalt, lithium, they're required to partner with the mining companies and invest in those companies to ensure they come online. So last year, we advised General Motors on their investment into Queensland Pacific Metals. That was a $79 million investment, and in doing so, they managed to secure a future supply of nickel sulfide. We're seeing a lot more of that activity pick up now. General Motors have also just invested $650 million into Thacker Pass, and so these check sizes are getting bigger. So upstream, we're seeing a lot more capital being invested in that space. On the technology side of things, that's also quite an interesting space. New technologies, new chemistries are developing. We saw Group 14 recently raise $600 million. That was led by owners and decarbonization partners. We also saw Form Energy, an iron air battery technology company, raise $400 million. TPG and GIC led on that round. So the technology space is certainly managing to attract investment. But again, on the manufacturing side, what infra-like investors are looking for is firm binding offtake contracts before they make those investments. Now, to do that, you need to go through A, B, C, D sample testing, and generally OEMs will sign binding offtake contracts once you've completed B sample testing. But that process in itself can take 18 to 24 months. And so the question is sort of how you bridge the gap from where you are today to the end of the B sample testing. What we are seeing now is that a lot of battery manufacturers are realizing that utility companies are able to sign binding offtake contracts a lot more quickly because the health and safety issues are not as onerous as they are for mobility. And so from that perspective, batteries are pivoting towards focusing on stationary storage and supplying customers. So we saw Next Energy, a US battery manufacturer, they've just announced a JV with Berkshire Hathaway to install stationary storage capacity in their solar plant in the US. But I don't know, Ross, if you're seeing the same thing on the stationary storage side.
Yeah, absolutely. And I think there's some really interesting dynamics going on in the stationary storage side. And first of all, it's probably worth contextualizing the market. So in the next year, there will be around 27 gigawatts of capacity installed globally. So clearly a very exciting marketplace. But maybe just to give some more context to that, if you were to take the top 10 largest storage developers' pipelines, add them together, it would still only be around 10% of Volkswagen's order book for batteries in the next 3 years. So clearly automakers are really making a play into this space in a very serious way, and that leads to some interesting competitive dynamics for stationary storage players, particularly in procurement. Really what we are seeing though is an important change in the more developed countries for stationary storage. So markets like the UK, where we have nearly 2 gigawatts of installed capacity, those assets have been built on a revenue structure that's predicated around ancillary contracts, so effectively revenue support contracts that reward for flexibility and response time from the national grid. The real change here is that those contracts are starting to become saturated and people are increasingly bidding in for them to the extent that it is reducing in price materially, and therefore people are more exposed to merchant trading in batteries, which is a very different risk profile for a typical infrastructure investor. So what that really does is change the emphasis on the technology mix as well. So a longer duration battery, for example, a 2-hour storage system, is more able to capture the merchant revenue profile of a storage asset in the UK, and therefore investors are really having to think about the risks they're undertaking.
And we've seen quite a divergence in terms of legislation across the US and Europe. A lot of my clients are now considering moving to the US just given the legislation, the environment in which you can operate in the US, subsidies from the governments, and also demand. Is that something you're seeing on your side?
Yeah, absolutely. I think the Inflation Reduction Act has spurred a huge interest in the US storage market particularly, but also in EVs, which I'm sure Ralph will talk about in a moment. But really, a lot of our European clients are thinking about the US as a key market, particularly in terms of revenue structures, access to certain grid establishments, and really California appears to be leading the way at the moment from our side.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.